All right, guys, we're live today. Trigger Points episode 18. We've got 4 new investors that we're going to talk to today and get them comfortable with hard money lending. So I want to thank everybody for showing up today. First and foremost, this is going to be a learning opportunity for you and anybody that's watching. So thank you all for joining us. So with that being said, who's got the first question?
Can you explain exactly what hard money lending means?
So hard money lending means we're lending money on an investment property, meaning it's a hard asset. Typically, how hard money works is we are going to evaluate your property, meaning it is an investment property and you want to flip this property or buy, fix, and hold it. So what we'll do is we'll do an initial valuation on a property and let you know what we can lend. Now, the way typically it works is that we're going to loan 70% of whatever the future value is. So if that future value, let's say, is $100,000, the most that we typically can lend is up to 70% of that $100,000 because that's what the market is telling us that property will sell for when it's fully rehabbed. So my total loan as a hard money lender is $70,000. Now that's all inclusive of your repairs because we do 100% financing of repairs, and whatever is left over can go towards your purchase or acquisition costs. So typically, what we do is when we do our evaluations, our investors say, "Okay, I understand that this property has got 20,000, let's say, in repairs. So off of the top of that 70,000, I'm going to take the 20,000 away, leaving 50. Now, your cue is to be buying these properties once you've done your evaluation at 50 or below to get as little out of pocket as possible, or if you buy it even further below the 50,000, we can roll all of those closing costs in, so you're zero out of pocket. So that's the nuts and bolts of kind of what hard money or asset-based lending is. Anybody got an additional question?
What do you need in order to qualify for a hard money loan? Or yeah, what do you need in order to get a hard money loan?
So typically, what you need is one of three. I'm going to say 4 things. You need to have a property that we're willing to do a rehab on with you, meaning that it's not a tear down. Tear downs, new construction, are a total different animal than going in and flipping a property and putting it back on the market for sale. When you go for tear down and new construction, you've got to, I would say for new investors, you've got to have some pretty good backing to ensure that you can get through that project. So first of all, if it's a flip, it can't be a tear down. Number 2, cash reserves. We want to see that you've got enough cash reserves to handle this loan. And you're probably saying, okay, what do you mean by handle the loan? The last thing I want to do as a hard money lender is put anybody in a lending situation that they can't afford. Meaning, this is kind of how we underwrite. We say, hey, 1, can you make payments for at least 6 months? And number 2, considering we are lending on a future value, meaning the property is not to that value, we require you at closing to come out of pocket at least a third of the repairs that you work out with your contractor. That way, those third of the repairs are done and you've added value, not counting demolition. You've actually added value to the property. That way, it's worth more. You kind of understand where I'm going? So as
Hey
long as
Rob,
you
there's one more. There's one more trying to hop on.
okay, as soon as they pop up, I'll add them to the stream.
Okay, thank you.
So, so that's number two. One, you've got cash assets to make payments for 6 months, and number two, you can at least do a third of the repair costs. We kind of add those two up, and if you meet that criteria, that's number two off the check mark. Number three, credit is a little important, but it's not 100% important, especially when it's a flip. If it's a buy, fix, and hold, that's where kind of credit comes into play. We want to make sure that you have at least good enough credit to refi out of our loan, or that we can get you refied out of our loan, because we also have 30-year non-QM products, which we'll talk about in a little bit. Our 30-year non-QM products have at least a minimum of 650 to 680 credit score. So we want to make sure.
Hey guys, so sorry about that.
It's okay. It's okay.
Hey, Tim.
So we want to make sure if it's a buy, fix, and sell, credit's not an issue. If it's a buy, fix, and hold, credit kind of becomes an issue, so that we can assure that you're able to hold that property for a long-term exit strategy. So that's number three. And number four, I will say this is kind of the least thing, because typically investors don't have to worry about this, but building a relationship with your lender, character is one of the biggest things that we pay attention to, and how you kind of qualify to do business with us. We want people with good character. We want people that are honest and run their business the way that they're supposed to. And I think that's one of the things that we pay attention to when we're underwriting these files is this somebody we want to build a long-term relationship with and do multiple deals with. And typically, we try to treat everybody here at Jet Lending and all of our clients like family, because we're always wanting to watch your back, because if you get into an investment property, this is your life savings that you're trying to grow your wealth on, and I want you to be taken care of. I want you to be underwritten like you're part of our family. So that's typically how you qualify for a hard money loan. Next question.
How many months are you looking for?
So as far as liquidity, we're looking for at least 6 months of interest payments. And again, 1/3 of the repair costs for cash assets. Now, if you're any money out of pocket, meaning you're buying the property outside the 70% spread, meaning that your acquisition costs and repairs are above our 70% spread, then we have to tack that on as proof of funds as well. So typically, we can do 100% financing on any of our fix and flips if you're buying it in that spread. But let's say you're 5,000 out of over that 70% spread, and you've got 6 months of interest payments, and you've got 1/3 of the repair cost. We will tack that 5,000 on top of that to ensure that you have that to bring to closing. So when you're out of pocket any money at closing, typically that's not a down payment. That's just the part of the loan that we can't cover because you bought it outside the 70% spread. Does that make sense to everybody?
Yeah.
Okay. Any other questions? Let's kind of keep them rolling if y'all'd like.
How many properties can we pick up at once?
Let's see here. How many property? That's a great question. I've got people that do one at a time. I've got people that do 5 to 6 at a time. It just depends. Typically, what our main concern is that we don't want to overextend you. We want to make sure that you have enough cash to handle 1, 2, 3, 4 loans. So if you've got 20,000, let's say you got 20,000 proof of reserves for this one loan over here, and you say, Rob, I want to leverage myself to do multiple deals. Well, typically we're going to add that 20,000 in proof of reserves next to the next property, which is, let's say that proof of reserves require you to have 21. So if you've got $42,000 in the bank, then you can do those 2 properties. If you've got another one, then you've got $70,000 in the bank, and that covers that. It's one, we just add up the proof of reserves requirement for each property. As long as you have that, you can do multiple deals. We'd never want to put you in a situation that's going to overextend you, because typically cash is what saves you when times get hard. So that's kind of why we underwrite the way we do, to ensure that you're not getting in a situation to where you can't do multiple deals. You may start off with one and build yourself up to doing 4 or 5 at a time. I've got clients right now that I mean, heck, I've ordered 3 appraisals in 1 week for some clients. So you can, and I encourage you to do multiple deals. So yeah. Joseph has a question. Let's show what Joseph says. Sorry, I joined a little late. Aside from third of the repairs, 6 months of interest payments at closing, is there a down payment requirement? No, Joseph, there is no down payment requirement at all. We can do 100% financing on every one of our hard money loans. I will go over the example again. Let's say, for instance, you got $100,000 ARV. Our total loan is $70,000. Minus the repairs at closing, there's $50,000 in this example left over to go towards your purchase price. Let's say your purchase price is $40,000 to $45,000. That means I can roll your closing cost and everything into this loan, and you're zero out of pocket. So your key is to be buying these properties somewhere between 55 and 60% of ARV every time, so that you are zero out of pocket. Now, does that mean if you're $10,000 out of pocket that you can't make it up on the back end? No, that is absolutely within your means to be able to do. So typically, I don't require a down payment, but you may be paying 55, 60 for the property, and it's still a good flip for you to make, 15 to 20,000 on. You've got to be able to willingly take that risk up front and say, you know what, I'll make it back on the back end. Instead of selling it for 100,000, I'll try to sell it for 110 and make up my money. Or you sell it for the 100,000 and still make a good profit. So typically, we do not have any requirement for down payment. We can do 100% financing. Next question.
Hey Rob, worst case scenario, I know that we have, like you said something about a 6-month term, right? So worst case scenario, if we don't get the house sold by 6 months, what happens to that?
So let's say it's a larger rehab, and we know that up front, and you need more time to do a 9-month. We're a little bit flexible and not as rigid on that. We may have to charge more points up front to get you to the 9 or 12-month window, but typically we can go longer. But let's say, for instance, you said, Rob, no, I can get this done in 6 months, and you run over a little bit, maybe 10, 15 days. We'll work with you on that. We're not going to charge you an extension fee on 10 or 15 days. But if it goes over 30, and we're approaching, 30, 35, 40 days, typically it's 1 point extension for every 3 months past that 6 months. So that's why it's real important up front to say, Rob, this one's going to take me 9 months. Well, instead of charging you, another point, I may only charge a 1/4 point or a 1/2 point up front. And that way we get you squared away for that 9-month period. Does that make sense?
Okay, yeah.
Yeah.
Can we I know that you and we kind of like ran through Mountwood together. Is there any way we could pull up that example so that everyone can see how that works and like the breakdown of it?
I'm glad you asked that.
And then on that particular property, I know that it required a 60-day lease back. Can you also explain how that would work if a property did require a lease back?
So That's something that we could talk about. Yes. Let me pull up Mountwood here real quick. So you don't mind if I share your loan estimate, correct?
No, we're all friends here, friends and family here.
Okay. Well, it's going to be on Facebook too.
As long as my social security number, my date of birth isn't on there,
There's
it should be okay.
there's nothing on there.
Okay.
So let me download this. All right. Let's see. Share screen. Okay. Can everybody see this?
Yep.
So this is her property that she got an estimate on today. We took a look at it. Of course, this is what you'll get every single time that you're once you send a property into us, we will send this back to you within 24 hours. This is our pending evaluation. It's just basically saying, hey, this is what your loan's going to look like based upon what the comps are saying and what data we see in this in this market. So it's got it's got her personal information, meaning her borrower's name and the property address right here. This is a proof of funds that would be required for this loan. Now, there's a reason why this, and I'll do some manipulation on this loan and kind of show what she would need to pay to be zero out of pocket. Okay. So right now she was paying $359, ARV $599 with $100K in repairs. So total loan would be $419,300, holding $100K in escrow, leaving $319,300 to go towards your purchase price. Okay, we had a 6-month term. Monthly interest with taxes would be $4,463.92. That is with tax escrow at a 10.99% interest rate. We were 3 points of origination of your total loan, $980 processing fee, $375 doc order fee. Title fee right here is 100% estimated. This is not one of our fees. We estimate it for you so you know what your total closing costs are, leaving an estimated funds needed at closing $57,827. Okay. With that being said, if she wanted to be zero out of pocket on this deal, then her purchase price would need to be somewhere around $302,000, and she would have had no money at closing. So that's how you get into these deals for zero out of pocket. Any questions? Is that what you kind of wanted me to go over? That example?
Yeah, I wanted them to kind of get an idea of like what the process looks like as far as like once you define the property and then you get kind of like a quote from your general contractor on what that renovation cost looks like, and then what do they do after that, and how does that conversation look like after they identify the property?
So after you identify the property, so what I did is she said, hey, Rob, I've got a property. So I sent her over a link to input this property into our system. This is our system that it sends automatic updates to the client. Every day I come in and I check this, and all the information that she sent is right over here in her notes. So what we do is we take it and we evaluate the property by pulling comps, looking at the property address, and making sure that what's going on in this area, looking and seeing if there's any other rehabs, making sure that it's an up and coming area. And when we look at that property, we look at say, hey, what is it selling for? What are the highest ARVs? What is it going to take to get it to that property. So when what I did is I sent her over a link for her to input this data into our system, so that, and then asked her to send some photos over. So we take a look at it, and with our 20 years of expertise and knowledge, and doing as many flips as our underwriters have done, and that we have looked at and underwritten and been able to underwrite, when we say, hey, you know what, we agree, this ARV is somewhere around 599, 600,000, somewhere around there. So I'm going to manipulate this a little bit and show you how easy it is to become zero out of pocket on these deals. So just by simply changing that purchase price and nothing else, I go back to my example. Oh, hold on just a second. I've got to revoke this. Confirm the document again. So by her paying 302, she's only 827 out of pocket now. So the lower you buy these properties, the lower you get them to fit into that 70% spread, the whole lot more profit you're going to make on the back end. Now, that gets me to my second thing that I wanted to talk to y'all about. Give me just a second here. And give me just a second. I'm trying to find my deal analyzer. There it is right here. Give me just a second. This is going to pop up, and I'm going to kind of show y'all how this at current, what she's paying for it, what she could make on the back end. It's taking just a minute to open. Anybody got any questions while this is opening?
Do you guys look at the lease back at all, or does a lease back affect the deal at all?
Does a lease back? So a lease back doesn't affect the deal. You've just got to be willing to realize that you're going to have to pay those interest payments while the lease back is going on. And I have done that before. It's not 100% frowned upon, but it's something that if you're willing to take on that risk, then I say go ahead with it. Now, a 60-day lease back is a long time, but I mean, you yourself can only figure that out. If you're willing to take on that risk. It is a little risky, because what happens if you can't get them out in that 60 days? Then you're sitting there going, okay, now we got an issue. So this is a deal analyzer we put together. I'm just going to go over the terms real quick to kind of show y'all exactly what she could have made on this property. Give me just a second. This thing is not popping up the way I want it to. All right. Hold on just a second. I'm sorry. What were you were paying 357, correct?
3 for the house. They wanted, I got down to like 375, but I was trying to get them down to maybe 365, but
yeah,
they're not budging. So I'm gonna just wait a little bit.
Well, let's just say, for instance, you were able to get them down to 357. So the total loan would have been $419,300. Monthly payment 4463.92. 6-month loan. We'll put utilities. We'll put it at max 200. 6% selling rate. Let's say your second closing cost was going to cost you, we'll say $9,000. Out of pocket on the first deal, $55,827. There's no HOA fees. and let's say 599. Let's just say we'll say 600. So she would have made $51,000 and got her initial investment back if she would have got it down to, if she would have gotten the price down to 357. So that's a $51,000 profit margin and bringing $55,000 to closing. So at the end of the day, if you could have got it under contract for 357, is that a good deal for you?
Yeah, looks good to me.
Make 50,000 in 6 months. Some people don't even make that in a year. So this is a valuable tool that we send to a lot of our clients. They say, "Oh, I'm too much out of pocket." Well, too much out of pocket. Heck, to me, it looks like you're making 51,000 in 6 months. That's a deadgum good. That's a decent investment. So, Joe, somebody had another question, and the points are due on refi or sell, not time of extension. Yes. So just so y'all know, there's let's say you go past the 6 months, we just add it to the back of the loan. We don't say, "Hey, you got to pay this right now." We say, "Okay, hey, look, we know you're still in the middle of the process. We know you're still in the middle of selling this property. We are going to put this extension fee on the back of the loan, so you don't have to worry about it right now." So that is a very good point, and I appreciate Alex sharing that with us. Any other questions, guys?
Hey Rob, do you mind circling back one more time and repeating what the requirements are to qualify again? I'm sorry, I think
Sure.
one or two of us missed it.
Sure, not a problem. So the requirements are that you don't have a property that's like burned to the ground or a tear down, that you have enough cash to handle that loan, meaning 6 months of the interest payments and at least a third of the repair cost in cash value assets. And that, again, it's not a tear down. Credit is a little bit of a requirement if it's a buy, fix, and hold strategy. If it's a buy, fix, and sell, credit is still pulled, but it's not contingent upon underwriting. Now, if I've got somebody with the 400 credit score, we may underwrite a little bit differently than somebody with a 700 credit score, meaning I may keep a little bit of at closing, make you pay, initially 300 or 3 to 6 months of payments in advance. That way, for your first deal, and then maybe down the road, we don't have to do that depending on how well we worked with each other and the relationship that we build. But typically, we will lend to 400 credit scores, and we'll lend, of course, to 700 plus 800 credit scores. So, and I think character, we've, in the past, is one of our last things that we kind of pay attention to. If you're not handling your business the right way, then we may decide that we're just going to part ways. And we've had to do that on a few loans since I've been here. So cash, credit, collateral, and character are the four biggest things that we pay attention to here at Jet Lending.
Thank you. Very clear now.
Okay. And guys, look, just because we're doing a Zoom call today, and you're not 100% comfortable, doesn't mean that you can't pick up the phone and ask 1,000 questions. We've got the reason why I went live on Facebook today is so that y'all can always go back and research this and rewatch it and say, you know what, I missed that. Let me go back and see what he said at that point in time, or just, share it with your friends. That way that they can learn as well. We're all about educating new investors or educating, experienced investors that didn't know that we have 30-year non-QM loans. So let's just say, for instance, you've got a buy and hold strategy, and you've got through the rehab, and you're ready to refinance, and you don't want to go through the hassle of traditional mortgage companies where you have to provide letters of explanation on every single dime that's hit your account in the last 6 months. And, oh, by the way, you got to go give a blood sample because they don't trust you. And they want to know why you moved 5 times in the last 6 years. That gets tiresome. So I've got 30-year non-qualifying mortgages, which is a bunch of Wall Street guys came to us and said, hey, we got money we want to lend out. We're going to let y'all underwrite it the way y'all see fit based upon, is this property income producing? And is it meeting a debt service cover ratio that we're comfortable with? And if those answers are yes, then we close it. Now, there are some requirements that are not as stringent as it is getting a mortgage. You got to have a qualifying credit score, and you got to have some assets in the bank. Remember what I said earlier, cash is king. So when you get in trouble on an investment property, let's say a tenant all of a sudden moves out, they want to ensure that you've got enough liquid assets to cover the rents for at least 6 months or more. And that's, typically the only requirements they really have. Other than that, any other questions? We could stay here all day if y'all like.
Did you go over the interest rates, Rob?
For non-QM or for hard money?
Hard money.
Hard money rates are anywhere from 10 to 12 points, depending on what your credit score is and how many. Let's just be honest, building a relationship starts anywhere. It's all about our comfort level with you and your comfort level with us. Interest rates are anywhere from, like I said, from 10 to 12 points, with 3 to 4 points of origination. Doesn't mean for your first deal that you get the best rates, but once we build that relationship and we've got, a good working relationship and we work towards, getting to know each other, then, we can work towards better rates. Most important thing you that I would say that you need to pay attention to more than anything is that we get the deal done and we say we're going to close. For our 30-year non-QM rates, I've got rates as low as 3.99, but can go as high as 9%. So I mean that's literally where you're at on the non-QM and the hard money side. We're a one-stop shop. So once you come here, if you want to go through the whole entire process, buy, fix, and hold, buy and hold, or buy, fix, and sell, you don't have to go anywhere else. Another thing, and last thing I kind of want to touch on, let's say you got an investment property that's rent ready and the renter's already in there and you're buying it from another investor who wants to dump some of his investment properties. We can go straight into a long-term strategy. No issues with that at all. We can do 80% of purchase price, or on a refinance up to 80% of as-is value on our 30-year non-QM loans. Any other questions?
Hey, Rob, are you getting the little chats on the side? Austin asked, is there any prepayment penalties?
There are no prepayment penalties, Austin. That's a great question. Let's say, for instance, you get into one of our loans and 60 days go by and you're like, hey, I am ready to get out of your loan. Absolutely. Hard money, no prepayment penalty whatsoever. Non-QM, it depends on the program that we go with, but there are some prepayment penalty for long-term strategies on our 30-year non-QM. Like I said earlier, these are Wall Street guys that want to put their money to work. They want this money deployed into real estate and into investment properties. So typically there is some prepayment penalties on that side. It can go anywhere from 1 to 7 years on prepayment penalty. But that's just on the 30-year non-QM loans or correspondent loans that we have. Also, let's say you find an investment property that's in a non-rural area that's outside the state of Texas. We got you covered. We can definitely do those loans as well. but it cannot be considered rural or in a rural area. So yes, to answer your question, there are no prepayment penalties with hard money. None at all. Last question, or any more questions?
Hey Rob, I know you mentioned like the loan origination points or something like that. Can you help explain that to anyone that doesn't understand what that means?
So origination, and I'm glad you brought that up. Sometimes I talk like an experienced investor, and most people don't. The origination points are what it costs Jet Lending to do the loan. It's basically what it cost us to originate the loan, to use our money. So it's usually anywhere from 3 to 4 points of the total loan. Meaning if your loan is $100,000, 3% of that, which would be, you say 100,000 times 3%, that's $3,000. Okay, easy math. So that's what the origination means. Our interest payments, or the interest rate, they're interest only payments with taxes for the term of the loan. So let's say your interest rate is 10.99 for 6 months. It's an annual percentage rate with taxes. So at $100,000 loan times 10, let's say 10.99%, typically you're somewhere around $1,099. That's just for the interest. On top of that, we add your taxes, and that will be your full payment. Is that pretty clear for everybody?
For me, yeah.
Okay. Amy, Austin, Colby, any of y'all got any additional questions? Okay, hold on. We do have a question right here. On fast track rehab, is there additional costs? How does that work? Thank you. Joseph, I appreciate you asking that question. So we have a program with Fast Track. It's called a no-draw loan. I'm going to explain this the best way I know how, so please forgive me. I'm very familiar with it, but sometimes I have a little bit of trouble explaining this. Typically, when you have when you close a property, we're going to require you to do a third of the repair cost out of your own pocket. With Fast Track, we still want you involved in the process. We still want you to meet with them and all that stuff, but we advance them a third of the repairs at closing after it's closed and funded. That way you're zero out of pocket after closing. So that is a beneficial cost to you. With Fast Track, they do a turnkey rehab project for you. So they are your GC. They take care of everything. So basically, what you do is you hand them the keys, but you can be as involved in the process as you want to, or you can be as hands off in the process as you want to. If you want to go back to some of our videos, some of my trigger points that I did a trigger point with Elijah, and he goes into depth about how some clients just hand him the keys and walk away, and some clients say, hey, I want to be involved. Now, I recommend, and some of us here recommend, you still need to approve the work that they're doing prior to a draw being made, because they'll contact us and say, hey, we're at this point, we're ready for another advance. I recommend that you be involved in the process. That way, you know where your money is going. And because at the end of the day, it is your money, but we worked it out with them to say, hey, we trust the work you've done. We've got a good relationship with you. We'll just advance you instead of making you do draws against it. We'll make you do advances against it. That way you're staying ahead of your project. They do very good work. When they say that they're going to meet a deadline, they're going to meet that deadline. As far as additional cost, Joseph, I would say you need to talk with them about that. I would dare not want to quote additional cost for another company. I just know that our fast track no draw loan, a lot of new investors like it because they don't have to worry about the headaches of worrying about a GC walking off the job, worrying about GCs trying to rip them off, worrying about this, worrying about that. You know, it's basically taking the rocks out of the duffel bag, so to say. And if that's beneficial to you, then I dare say give them a call and let them talk to you. Any last questions? Hello?
Nope, that's it for me.
Everybody else good?
I'm good, thank you.
Amy, thank you. Colby? Everybody's good? Well, guys, hey, look, I hope everybody has a wonderful weekend. This has been a great episode. I think a lot of people got a lot of great knowledge out of this. I hope that you will take this and move forward and go out there and kill it. The main thing that I want to leave you with is, you know, mindset in this industry is everything. Mindset is everything. So as long as you've got the right mindset to move forward and get these properties under contract, I think every one of y'all are going to kill it. And I appreciate y'all giving me the time to teach y'all a little bit. And if y'all got any questions at all, y'all, my phone number is 903-806-4400. It's right down there on that ticker. You can always come back to this video. We've got YouTube channel with plenty of education. We've got, you know, I do trigger points every Friday. Typically didn't do one last week, and I wanted to wait to go live today to make sure that y'all had the same opportunity that these four people that wanted education. So if anybody needs anything at all, please feel free to reach out. We're always here, and we will always help you get your deal across the finish line.
Okay.
Anything else?
Thank you for taking the time out.
Yeah, yes. I hope everybody has a great weekend. And if y'all need anything, let us know.
Okay, thank you.
All right, that's it for this episode of Trigger Points. We'll see you guys next Friday. Thanks, guys. Out here.